This hearing will come to order. We'll have opening statements, 10 minutes on each side, the majority and the minority. And there may be members in attendance that are not assigned to the Housing and Insurance Subcommittee. And if you do, we will recognize those members. Without objection, members of the full Financial Services Committee who are not members of this subcommittee are welcome to sit down on the dais and participate in today's hearing. Without objection, members of Congress who are not members of the Financial Services Committee may sit on the dais today, but consistent with our committee policy, they may not be recognized or yielded for any purpose. If they have any written statements, we'll include them in the hearing. At this particular point in time, and I will give my opening statement. Thank you for being here today. I think this is an important hearing, and we're going to talk about 5 legislative proposals to reform the domestic insurance policy in this country. This hearing will give many of the stakeholders in this room much needed respite from our TRIA deliberations. And speaking of TRIA, I noticed that in the audience today there are some few people here that may have a little bit of an interest in that subject. And just to let you know, a little bit of an update, we are working very hard on this issue. Just a couple of weeks ago, as you may know, we sat down with some of the members of the majority that sit on the committee, and we laid out a framework for them to review. And we opened up a dialogue and a discussion with those members, and we've been getting some very valuable feedback. And in the very near future, we plan to, once we've made some refinements in that framework, to sit down with the minority as well, because we would, it's our goal, hopefully sometime in June, to put out a bipartisan, hopefully it would be a bipartisan bill on TRIA. To move out of this committee and hopefully then put it in the hands of leadership and let them determine when we might look at passing that on the House floor. But I just wanted to give you a little bit of an update. You know, as many of you are seasoned veterans around here, we know that it doesn't always go on schedule, but that's the schedule that we have today. But today we turn our attention to some insurance reform legislation that focus on protecting policyholders, offering more consumer choice for insurance products, and providing regulatory relief to reduce costs to domestic policyholders. First, we will examine legislation that ensures that regulations intended to rein in certain activities of large, complex financial institutions don't trickle down to insurance companies that are properly regulated at the state level. H.R. 4510, which was introduced by Representatives Miller and McCarthy, would clarify that application of capital requirements to insurance companies that are subject to Fed supervision. This bill would simply ensure that capital standards intended for banks are not needlessly applied to insurers that own financial institutions. H.R. 6605, introduced by Mr. Posey, would make certain insurance companies not subject to federal assessments to pay for the orderly liquidation of failed financial institutions, given that state insurance laws already govern the process for unwinding failed insurers. Secondly, we will examine the legislation intended to protect insurance policyholders who are customers of a bank-affiliated insurance company. H.R. 4557, introduced by Mr. Posey, would allow state insurance regulators to intervene to protect the soundness of the insurance company affiliate with a failing financial institution. This will allow regulators to ring-fence insurance-specific assets so that policyholders are protected in the event of insolvency. And finally, the subcommittee will examine 2 draft proposals intended to increase consumer choice and reduce unnecessary regulatory burdens. The first is authorized by Mr. Ross from Florida, would modify the Liability Risk Retention Act to allow self-insured liability risk retention groups to create efficiencies by expanding their commercial lines of coverage. The second, authorized by Mr. Stivers, would lessen the regulatory burdens associated with data requests from insurance supervisors. I applaud all of these sponsors of these bills as we plan to examine today, and separately I would like to acknowledge Mr. Duffy for all of his hard work he and his staff have done on the Miller-McCarthy capital standard bills. Also, I'd like to recognize Mr. Duffy and that he just recently added another member to his family. I believe this is number 7, and it was a little girl.
Seven.
Yeah.
7.
Yeah.
I'm very productive.
A little overproductive.
So I look forward to a very productive hearing, and now I'd like to recognize the ranking member, Mr. Capiano, for 2.5 minutes.
Thank you, Mr. Chairman. I want to thank the panel for being here. I think there'll be some good discussion today. I don't think there's going to be a lot of debate. There may be some basic issue. I think most of these issues that are proposed in these bills are reasonable and thoughtful. Again, there'll be some details, but overall, I'm looking forward to some discussion to see if we can come up with easy ways to do some easy things without complicating them with unnecessary extraneous material. Thank you very much.
And now I'd like to recognize Mr. Duffy for 1.5 minutes.
Thank you, Mr. Chairman, for holding this very important hearing, and I appreciate the panel coming in and dispensing some of your wisdom and thoughts on the bills that we're talking about today. I just want to say a few brief remarks about the Miller-McCarthy bill, a great bipartisan proposal, I think, that goes a long way to fixing a problem that I don't really think existed. We know the Fed interpreted the Collins Amendment differently than probably most everyone else in this room, and so we now have, I think, a bipartisan legislative fix that addresses that Fed interpretation. Listen, I don't think anyone anticipated that we would apply bank capital standards to insurance companies, and that was never the intent of the Collins Amendment. The Miller-McCarthy bill will address that issue, making sure that we treat insurance companies very differently than banks in relationship to the capital in which they're required to hold. So I look forward to your testimony and your views on all the bills, but specifically in regard to Miller-McCarthy. And I want to also extend my thank you for Mr. Miller and Mrs. McCarthy for their bipartisan effort in bringing out this proposal. I yield back.
I thank the gentleman, and now the gentleman from California, Mr. Sherman, is recognized for 2 minutes.
Thank you. We need to pass reauthorization of TRIA. That isn't on the agenda today. We saw with AIG an excellent case study. That portion of the enterprise that was subject to state insurance regulation remained healthy, even though the top managers in the company were behaving like drunken sailors. Those parts of the company that were not subject to state insurance regulation crashed as if they were being run by drunken sailors. The other thing this proves is that credit default swaps are insurance and should be treated as such, and we probably would not have had a 5-year catastrophe in our economy had we done two things, one on the credit rating agencies, and the other is to require that portfolio insurance be called insurance. We're dealing with a number of bills today, two that are important and that I'm happy to co-sponsor. One is the Miller-McCarthy provision summarized by the last speaker, and that is that we need to use insurance accounting principles to determine the creditworthiness of insurance companies. The second, the Policy Protection Act, introduced by Mr. Posey, and I guess I'm the chief Democrat on it, recognizes that you should not invade an insurance company and seize assets in a way that that endanger its policyholders simply to shore up a related and affiliated bank or other depository institution. What the bill does is it takes the policyholder provisions that are already in the Bank Holding Company Act and puts them also in the Thrift Holding Company Act. And with that, my time has expired.
I thank the gentleman, and now another gentleman from California, Mr. Royce, is recognized for 2.5 minutes.
Oh, thank you, Mr. Chairman. And just a reminder for my friend from California that the securities lending operation of AIG was regulated at the state level. But this hearing on legislative proposals to reform domestic insurance policy confirms a new normal for insurance regulation in the United States. It's basically a hybrid model with layered regulation by states and the federal government. The age-old debate of state versus federal regulation is aged, is old. The new reality involves state regulators. It involves the Federal Reserve. It involves the Treasury Department, both through FSOC and through the FIO. Many of the bills before us today are a response to this hybrid model. In particular, H.R. 4510, the Insurance Capital Standards Clarification Act, offered by the gentleman from California, Mr. Miller, reflects a belief that insurance capital standards set by a traditional bank regulator, the Federal Reserve, need not be bank-centric and should, in fact, be tailored to reflect the unique and specific business model of insurance companies. I strongly support this bill. Regulation can take place at the federal level, but it must be smart and specific to insurance operating models. And without changes, the current hybrid insurance regulation structure has the potential to fail consumers miserably. A system which produces regulatory confusion, hinders consumer choice, discourages competition, that is burdensome for all parties involved. And I have said this before. It very well may be a system that has not failed, but since when has non-failure been a synonym for success? Unlike some of my colleagues, I believe much of the problem is lack of uniformity at state levels. Within this hybrid framework, we should effectuate uniform domestic regulations. And toward this end, yesterday, along with Representative Tammy Duckworth, I introduced the Service Members Insurance Relief Act, a straightforward bill to ensure portability of auto insurance for all our service members who often move from state to state. This bill is a perfect example of a simple fix to the insurance regulatory framework that will make a big difference in the lives of American consumers, and I'm hopeful this committee will move our new system of insurance regulation forward. We should start with immediate passage of 4510. Thank you very much, Mr. Chairman.
I thank the gentleman, and I want to also now recognize the gentlewoman from New York, Mrs. McCarthy, who has one of the primary authors of 4510 and has worked tirelessly on this issue, and I thank her for her work. And she's recognized for 2 minutes.
Thank you, Mr. Chairman. I appreciate you holding this hearing, and I thank my ranking member. I want people to know that when we did Dodd-Frank, the bill that came out of this committee did not bring the insurance companies in. That was done over on the Senate side, and Senator Susan Collins of Maine has stated publicly now that she never intended to have bank capital standards applied to insurance companies. Our bill, Mr. Miller from California, unfortunately, who could not be here today, H.R. 4510, this bill, which I sponsored, will help keep insurance products affordable and available by applying and ensuring the correct capital standards are applied to insurance companies that fall under the supervision of the Federal Reserve. The intention was never to have them involved with this. This legislation will give the Federal Reserve more flexibility and help clarify the difference between the business of insurance and the business of banking. The legislation starts from the premise that applying the wrong capital standards, such as bank capital standards, to an insurance company is ineffective, disruptive both to the insurance company and its policyholders. In the absence of this legislation, the Federal Reserve has said it will be obligated to apply bank capital standards to insurance companies under its supervision. Since the insurance business model is so fundamentally different than the bank business model, those bank-centric capital standards would be very pragmatic for insurers and the many families and retirees who are their policyholders. As I've mentioned, Senator Collins, the original author of the amendment, is sponsoring it in the Senate side with the correction, exactly the same as this legislation is. She will be co-sponsoring it with Senator Brown and Senator Johans. I am pleased to support this common sense legislation, which will play an important role in preventing future financial crisis. And I apologize, I had root canal this morning, so I'm still a little bit numb. That I yield back.
I thank the gentlewoman, and now the gentleman from New Jersey, the chairman of the Capital Markets Subcommittee, is Mr. Garrett, is recognized for 1.5 minutes.
Thank you. And at first I want to begin by thanking the chairman for holding this important hearing to examine various proposals to reform the domestic insurance policy. I'd also like to thank all of our witnesses for serving on today's panel. You know, July will mark the 4th anniversary of Dodd-Frank. And it's not surprisingly, in the nearly 4 years since Dodd-Frank became law, the committee has had to consider a number of fixes to help clean up the regulatory mess that Dodd-Frank created. Now, one of those law's most recent messes concerning the Fed's application of bank-like capital standards to insurance companies. And under Dodd-Frank, the Federal Reserve is required to impose minimum capital requirements on the companies it supervises, including insurance companies that own savings and loan associations and insurance companies deemed systemically important. However, insurers face very different capital structures than banks, and as such, it would make sense that the Fed should not treat insurance companies in the same manner when it comes to assessing these capital requirements. Unfortunately, the Fed maintains that Dodd-Frank requires the application of bank-like standards, even though Congress never intended such a standard to be applied to these companies under the Fed's jurisdiction. So we have the Insurance Capital Standards Clarification Act now before us, and this would clarify that the Fed is not required to apply inappropriate standards to insurance companies that are already subject to appropriate state-based or foreign capital requirements. See, at the end of the day, inappropriate regulations hit our families and small businesses in the pocketbook. So I hope that this hearing highlights the need for yet another round of Dodd-Frank cleanup. I yield back.
I thank the gentleman, and now one of our newer members to the committee, Mr. Horsford from Nevada, is recognized for 2 minutes, and welcome to the committee.
Thank you very much, Mr. Chairman, and thank you to Ranking Member Capuano. If I may take just a moment, I'd like to start by saying that it is an honor and a privilege to serve on the Housing and Insurance Subcommittee. During the recession, my home state of Nevada suffered the highest rate of foreclosures in the nation, and within my state, the congressional district that I represent was hardest hit. For my constituents, housing remains a top priority as we continue down the path to economic and financial recovery. So I'm glad that we're holding a hearing on the 5 insurance bills before us today. But I'm also a bit disappointed that TRIA is not on that list. Before coming to this committee, I served on the Committee on Homeland Security. There I heard firsthand from businesses and employers on the importance of having access to affordable terrorism risk insurance. These job creators have told me that this insurance provides a safety net that allows them to invest in growth without fear of losing it, all due to an act of terrorism. Most importantly, terrorism risk insurance reduces taxpayer exposure by confining most of the costs to the private sector. Without affordable terrorism insurance, many buildings, schools, and venues would remain uninsured against terrorist attacks, meaning that the government likely would pick up 100% of the tab for catastrophic losses. So I look forward to working with the members of this subcommittee to move forward on these important issues. And again, I'm very honored to be joining this committee and look forward to the work ahead.
I thank the gentleman, and now the gentleman from Florida, Mr. Ross, is recognized for 1.5 minutes.
Thank you, Chairman, and thank you for holding this hearing. Thank you also to our distinguished panelists for being here today and for your testimony. My discussion today is over my draft that aims to modernize the Liability Risk Retention Act and allows established risk retention groups, also known as RRGs, with adequate capital and surplus to offer to their members and only their members the inclusive commercial insurance packages that are the norm in today's commercial marketplace. Nationally, more than 25,000 educational, charitable, and Catholic institutions benefit from commercial liability coverage through an RRG. In my home state of Florida, more than 127 nonprofit organizations enjoy tailored liability coverage provided through an RRG, the Alliance for Nonprofits for Insurance. These community organizations do important work for our society, and any penny they can save on insurance costs means one more penny they can spend on their charitable efforts. My draft is targeted legislation that would provide these customers with the convenience of one-stop shopping with an insurance group of which they trust and are a member. My draft seeks to address some of the previous concerns about this expansion, and I look forward to today's discussions from all of our witnesses. In addition, my colleagues today have brought important bills for our discussion. I was pleased to co-sponsor Representative Gary Miller's bill, which would allow the Federal Reserve to tailor capital standards to the business models of insurance companies. We must ensure that Federal regulation of insurance companies is properly crafted and does not result in increased costs for consumers. Floridians already struggle with the cost of insurance. I want to make sure that the Federal Government does not worsen that burden. I yield back.
I thank the gentleman, and now the gentlewoman from Ohio, Ms. Beatty, is recognized for 2 minutes.
Thank you, Mr. Chairman and Ranking Member. And thank you to our witnesses for their testimony here today. This afternoon, we meet to discuss a series of legislative proposals that amend both long-standing and recently passed laws impacting the operation of insurers in the United States. However, none of these bills in any way addresses the expiration of the Terrorism Risk Insurance Act, which is slated to expire in just over 6 months. I and other members on both sides of the aisle believe that it is absolutely critical that we reauthorize this program in a timely manner so that insurers and insurers can renew their terrorism policies in a way that prevents lapse in coverages. It is clear that failing to do so would risk a complete pullout of the markets by these property and casualty insurers, which would be catastrophic for the real estate recovery and for the ability of companies to provide terrorism liability coverage for workers' compensation claims, which in many states is required by law. A recent study by the RAND Corporation found that premium increases in workers' compensation insurance may be insufficient to offset terrorism exposure. Mr. Chairman, I urge you to work with members of this subcommittee as well as members of the full committee in the House to bring a TRIA reauthorization vehicle through markup to the House floor post-haste. It is not just a matter of helping insurers, but more importantly, helping the American economy as a whole. Thank you, Mr. Chairman, and I yield back.
I thank the gentlewoman. And we will now hear from our witnesses. We have 5 distinguished witnesses today. Mr. Joe Carter, who is Vice President in Business Development and Marketing for United Educators. Mr. Gary Hughes, Executive Vice President and General Counsel for American Council of Life Insurers. Mr. Con Carroll, Federal Affairs Counsel, National Association of Mutual Insurance Companies. Mr. Joseph Kaufman, Chief Financial Officer and Treasurer, Westfield Group, on behalf of the Property Casualty Insurers Association of America, and Professor Daniel Schwartz, Associate Professor of Law, University of Minnesota Law School. Your written testimony will be made a part of the record. We ask you to summarize that in 5 minutes, and then we will move to question and answer. And Mr. Carter, you're recognized for 5 minutes.
Thank you. Thank you, Chairman Nagelbauer, Ranking Member Capuano, and members of the subcommittee. Thank you for this opportunity to testify in favor of the Risk Retention Modernization Act of 2014, which will allow established risk retention groups to offer additional forms of commercial insurance coverage to their members. We have also submitted a written statement for the record. I am Joe Carter, Vice President for United Educators Insurance, a reciprocal risk retention group, and I'm testifying on behalf of United Educators, as well as the Alliance of Nonprofits for Insurance Risk Retention Group, also known as ANNI, and the National Catholic Risk Retention Group, Inc. We are pleased that VCIA and REMS, the leading trade associations for captives and risk managers, also support this bill. United Educators, ANNI, and National Catholic owe their existence to the Liability Risk Retention Act of 1986. Congress was correct in assuming that risk retention groups would add capital to the insurance market, successfully moderate insurance pricing, and provide a stable source of insurance coverage for universities, nonprofits, professionals, and small businesses. In the 25-plus years since the 1986 Liability Risk Retention Act amendments, more than 250 risk retention groups have aggregated more than $2.5 billion in gross written premium. According to the rating agency AM Best, the focused approach of risk retention groups has resulted in aggregate operating performances that are, quote, consistently better than that of their peer group in the commercial insurance markets. Many nonprofits, small schools, churches, small businesses buy packaged policies that RRGs cannot write today. Many of these entities are therefore forced to forego the coverages and, more specifically, the tailored risk management services that our risk retention groups give to buy their policies outside of risk retention groups. If RRGs truly were only a response to a crisis in capacity for liability insurance, the member counts would surely have shrunk when the industry came back, the insurance industry came back into the market. Instead, risk retention groups have demonstrated that for certain types of similar organizations, collectively insuring each other is superior to relying on the traditional insurance sector. As member-owned entities, risk retention groups provide, or they proactively address coverage realities through risk-based research, actuarial-based pricing, and coverage levels that are designed to be sustainable. And any resulting profits are passed on back to the members who own us, keeping their operating expenses down. Our bill, which would permit seasoned risk retention groups to write other lines of commercial insurance, would bring more capital and more purchaser choice to the property and casualty market. However, not all risk retention groups could write other lines of commercial insurance if this bill becomes law. Instead, to write other lines, a risk retention group must be seasoned, meaning it must be licensed by their domiciliary state regulator and operating as a liability risk retention group for 5 years. They must also meet a minimum threshold capital requirement of $5 million and meet any other requirements that their state domiciliary regulator would require. This bill will not upend the Liability Risk Retention Act at all. Let me tell you what the Liability Risk Retention Act modernization legislation will not do. It does not authorize risk retention groups to offer personal lines of insurance or write group health, life, disability, or workers' compensation insurance. It does not alter any rights of non-domiciliary states. And it does not change a risk retention group's responsibility to comply with state laws on deceptive practices or unfair claims practices. In fact, one significant thing has occurred recently to strengthen state regulation of risk retention groups since legislation was introduced. RRGs are now subject to the NAIC state accreditation standards. Thus, RRGs are now subject to the same solvency standards for state accreditation purposes as other insurance companies. The amendments proposed to the Liability Risk Retention Act by this modernization legislation will simply permit risk retention groups to offer their members, and only their members, the same comprehensive commercial insurance packages that are the norm in today's marketplace, while benefiting from the customized risk management services that we're offering today. In closing, risk retention groups have dramatically improved risk management and provided tailored coverages for specialized niches like nonprofits and educational institutions, and modernizing this act would allow us to more effectively and efficiently continue this important work, which will allow them to continue to focus on the things that they're mission-driven. And thank you very much.
Thank you. And now we recognize Mr. Hughes. You're recognized for 5 minutes.
Chairman Neugebauer, Ranking Member Capuano, and members of the subcommittee, I appreciate the opportunity to provide you with the views of the American Council of Life Insurers on legislative initiatives addressing the way in which insurance is regulated in the U.S. I'd like to confine my remarks this afternoon to a single issue that's of paramount importance to life insurance companies, and that's the need to provide the Federal Reserve Board with the flexibility it believes it needs in order to apply insurance rather than bank capital standards to those insurance groups that now fall under its jurisdiction as the result of the Dodd-Frank Act. Dodd-Frank requires the Fed to apply consolidated capital standards to those insurance companies that are determined by FSOC to be systemically important, and also to those insurers that control savings and loan institutions. 2 of ACLI's member life insurance companies have been designated as SIFIs, and 1 additional company is under review for possible designation. 11 of our member life companies are affiliated with S&Ls, and taken together, these companies account for approximately 30% of the insurance premiums of ACLI's overall membership. Put differently, a very significant segment of the life insurance business is now going to have its group capital standards set by the Federal Reserve. But beyond having a direct effect on these companies, the Fed's determination with respect to U.S. insurer group capital standards could very well be a precedent against which all insurers are measured, since it would affect such a large segment of the market. It could also be a bellwether for similar standards being developed by international standard setters. The global competitive interests of U.S. insurers demands that every effort to be made to harmonize these emerging capital standards. The good news here is that the Fed appears to recognize that applying bank capital standards to a life insurance enterprise would be wholly inappropriate and could materially disrupt the company's operations. The frustration, as you all have mentioned, is that the Fed believes the wording of Section 171 of Dodd-Frank doesn't give it the latitude it needs to apply insurance-based standards. Now, to its credit, the Fed has temporarily exempted or deferred application of its capital rules to those insurance groups, thereby giving Congress time to clarify Section 171. but this is only temporary respite and hence the urgency for congressional action. We're very encouraged by the fact that Congressman Miller and Congresswoman McCarthy, and Congresswoman, thank you very much for your leadership on this, have sponsored H.R. 4510, the Capital Standards Clarification Act of 2014, and we would also note and thank the fact that a majority of the members of this subcommittee are co-sponsors, and thanks to you as well, Mr. Chairman, for your support. This bill would provide the Fed with the very flexibility it needs to craft capital standards suitable in the context of an insurance company. Also, as you all have mentioned, Senator Collins, the original architect of Section 171, has made it clear that she never intended for the Fed to apply bank standards to insurers, and she, along with Senators Brown and Johans, are advancing a bill similar to H.R. 4510 in the Senate. To be clear, the insurance industry is not trying to sidestep the application of strong capital standards as mandated by Dodd-Frank. We're simply working to assure that at the end of the day, the applicable standards are predicated on a framework appropriate for the business of insurance, such as the existing insurer risk-based capital system. This is a system specifically designed by insurance regulators for insurance entities and is a comprehensive and accurate measure of these companies' unique risks. In summary, Mr. Chairman, ACLI's legislative priority in the House is passage of H.R. 4510. We believe it's imperative that the Fed be afforded the flexibility to utilize insurance-oriented capital standards for those insurance groups under its supervision. Substituting bank-centric standards would harm the affected companies, undermine rather than strengthen the supervision of insurers, and would be completely at odds with efforts to enhance the stability of the U.S. financial markets. We look forward to working with this subcommittee and with both houses of Congress to pass this important piece of legislation. Thank you.
Mr. Carroll, you're now recognized for 5 minutes.
Chairman Nagelbauer, Ranking Member Capuano, and members of the Housing and Insurance Subcommittee, I'd like to thank you for holding this hearing on legislative proposals to reform domestic insurance policy. My name is Thomas Carroll. I'm the Federal Affairs Counsel for the National Association of Mutual Insurance Companies. We're the largest property casualty insurance trade association in the country, serving regional and local mutual insurance companies on main streets across America, as well as many of the country's largest national insurers. The 1,400 NAMIC members companies serve more than 50% of the automobile and homeowners market and 31% of the business insurance market. We're pleased that the committee is focusing on the issues related to property casualty insurance industry, which is highly competitive, well capitalized, and is a key source of strength and resilience for the U.S. economy. Our industry ensures the property casualty risks of the United States businesses and consumers, enabling the U.S. economy to thrive. It's imperative that we do not impede this well-functioning marketplace. NAMIC appreciates the opportunity to offer our comments. The most important proposal to NAMIC members is H.R. 4510, the Insurance Capital Standards Clarification Act. The Act would afford the Federal Reserve greater flexibility to apply accurate capital standards for insurers by amending Section 171 of the Dodd-Frank Act to clarify the application of capital requirements to insurance companies subject to the supervision of the Federal Reserve Board. There is widespread agreement that such flexibility is warranted and necessary. Senator Susan Collins of Maine, the author of Section 171, has made clear that she never intended to have bank capital standards applied to insurance companies. The Senator and a number of members of the House and Senate have urged the Fed to adjust the capital standards for insurance companies to align with the business of insurance rather than the business of banking. Despite this, the Fed maintains that it is constrained by the language of Section 171. H.R. 4510 resolves this question and acknowledges the fact that bank capital standards are not appropriate for insurance companies. It also recognizes the importance and appropriateness of statutory accounting principles. H.R. 4510 provides that the Fed may not use Section 171 to require insurance companies that are only required to prepare financial statements in compliance with state-based statutory accounting rules to also prepare financial statements under generally accepted accounting principles. Forcing such companies to prepare additional GAAP statements is a labor-intensive, multiple-year project that would cost policyholder owners hundreds of millions of dollars without adding any benefit in regulating the solvency and activities of the companies. Similarly, NAMIC supports the Insurance Consumer Protection and Solvency Act of 2013, or H.R. 605, which clarifies that the FDIC does not have the authority to assess insurance companies for the orderly liquidation fund. The existing state-based resolution authority for insolvent property casualty insurers has a superb track record of protecting insurance claimants and policyholders at no cost to the taxpayer. property casualty companies, and mutual companies in particular, present almost none of the risk factors the FDIC is statutorily required to consider. All insurance companies already meet guarantee fund obligations for the insolvencies in their own industry and should not be assessed the cost of failures in other parts of the financial services sector. Both of these bills recognize that the business of insurance is fundamentally different than the business of banking, and that applying additional bank-centric regulations are inappropriate and damaging to the business of insurance. NAMIC also supports the Policy Protection Act of 2014. The laws governing thrift holding companies do not provide the same procedural protections as the Bank Holding Company Act to ring-fence the assets of insurance subsidiaries for the protection of insurance companies. The Policyholder Protection Act of 2014 simply amends the Bank Holding Company Act to provide the same protections for insurance companies organized as thrift holding companies. Tapping the assets of insurance units, particularly without the consent of the insurance regulator, would inappropriately threaten the financial structure underpinning the insurance operations and undermine consumer confidence in the insurance industry. To protect America's insurance consumers, the Bank Holding Company Act protections should be extended to thrift holding companies, and NAMIC supports H.R. 4557. Finally, NAMIC supports the Insurance Data Protection Act, which would elevate the federal authority to subpoena information directly from insurance companies to the Secretary of Treasury, would also strengthen the confidentiality protections for the information and require reasonable reimbursement for the cost of compliance with the data protection. The Insurance Data Protection Act would not deny the Federal Insurance Office or the Office of Financial Research any relevant information or impede their functions, but would ensure that they take reasonable steps to prevent unnecessary and duplicative reporting by insurance companies. In fact, the legislation would afford insurers many of the protections recently highlighted in the Administration's Big Data and Privacy Working Group review. I want to thank the Subcommittee again for holding this important hearing and providing NAMIC with the opportunity to discuss these legislative proposals. I look forward to your questions.
I thank the gentleman. Mr. Coleman, you are now recognized for 5 minutes.
Thank you, Mr. Chairman, Ranking Member Capuano, and members of the committee. I am testifying on behalf of the Property Casualty Insurers Association of America, which is composed of nearly 40% of the nation's home, auto, and business insurers. My name is Joseph Coleman, Chief Financial Officer and Treasurer of the Westfield Group. Westfield is a mid-sized insurance company that has been in business for over 166 years with an A or higher AM Best rating for the past 75 years. We provide over 2,200 direct jobs in 31 states, partner with thousands of independent insurance agents to serve our customers, and are one of the top writers of farm business in the United States. Westfield also owns a community bank that originates roughly $300 million in loans annually, predominantly to owner-operated small businesses and individuals. We are not a Wall Street institution, but a very important regional provider of insurance and banking services to Middle America. PCI and Westfield support strong regulation, but our growth is being restrained by unintended consequences stemming from an expansion of banking regulation in the Dodd-Frank Act that conflicts with state insurance regulation. For example, the Dodd-Frank Act requires the Federal Reserve Board to impose the strictest bank capital standards on insurance holding companies with a depository affiliate, even just a small community bank. Westfield's business activities are primarily insurance. The measurements used to determine capital and leverage ratios for banking are completely different than those used to govern auto insurance or farm insurance. A strict application of bank capital requirements to our insurance activities just does not make sense. The Federal Reserve Board agrees. They recognize that insurance and banking operate with completely different business models. They have delayed implementation of the requirement until Congress can act, but not for long. Dozens of members of Congress, including Senator Collins, who authored the original legislative requirement, have written to the Federal Reserve Board saying that this application of bank regulation to insurance is inappropriate. Fed Chairman Yellen testified under questioning that this is an unintended consequence of the act. Yet the board says they do not have the statutory flexibility to provide relief unless Congress acts. Please pass H.R. 4510 to help Senator Collins clarify the intent of her original amendment and to allow the Federal Reserve Board to apply appropriate capital standards to insurance companies. PCI strongly supports the other bills before the committee as well. H.R. 605 ensures that resolution of insurance companies and their assets is conducted by insurance regulators, not by a federal banking agency. It would also prevent the FDIC, who's primarily responsible for bank resolutions, from using insurance assets to support failing banks. Insurers are already responsible for resolving their own failures and pay for guarantee funds in every state to protect consumers. Do not let insurance policyholder protection funds be used to support risky investment firms and banks. H.R. 4557 requires federal bank regulators, before transferring assets of insurance companies to banks, to ask the insurance regulator to determine if the transfer would harm the insurer. This seems like another common sense clarification to limit a regulatory conflict of interest and avoid harming insurance policyholders to support a bank. The proposed Insurance Data Protection Act would provide additional protections for confidential proprietary data shared among insurance companies and government entities, and limit rather extraordinary regulatory subpoena power given to non-regulators. This will prevent potential costly data calls by entities who neither supervise our companies nor are responsible for their solvency. The theme of all these bills is that insurance and banking are fundamentally different. Congress has the opportunity to clarify that regulation of insurance companies and their activities should be conducted using insurance standards and by their supervisors. Thank you for the opportunity to testify today, and I'm happy to answer any questions the committee may have.
Thank you, Mr. Coleman. And now, Professor Schwartz, you're recognized for 5 minutes.
Thank you very much, Chairman Neugebauer. Thank you, Mr. Capuano, members of the subcommittee, for inviting me to testify. I'm going to spend most of my oral testimony talking about several of the legislative proposals. But before I do that, I think it's important to foreground my remarks in certain facts that I think that have gotten lost in this discussion. Those facts include that AIG's securities lending program was at the heart of AIG's problems, in addition to its credit default swap portfolio. And that securities lending program, as mentioned earlier by one of the members, was indeed subject to state regulation. Those facts include the fact that financial guarantee insurers, monoline insurers, contributed mightily to the crisis, and they were regulated by state insurance regulators. Those facts include that life insurers that had issued long-term guarantees, via annuities mostly, suffered severe capital shortfalls during the crisis that led several of them to apply for bailout funds and to receive bailout funds. The point I am making is this. I agree with everyone that insurance is different than banking, and it must be regulated in a manner that is different than banking. At the same time, insurance does raise systemic risks that warrant a robust federal involvement in the industry. We cannot simply defer to state regulators when issues of systemic stability are in play. With that in mind, I want to talk about several of the proposed legislative initiatives. First, the Capital Standards Clarification Act. I support the vast majority of that bill. I agree that the Federal Reserve should not mechanistically apply bank-centric capital rules to insurance companies because insurance companies present different risks. And so for that reason, I agree that the Congress should clarify that the Fed has the discretion to tailor capital rules. Moreover, I think that it's a virtue of the bill that it allows and affords the Fed the discretion not simply to move away from simply mandating bank capital rules, but also to tailor capital rules so that they don't simply replicate state risk-based capital rules, but actually respond to the fact that while state risk-based capital rules are about policyholder protection, federal capital rules are by and large about something different. They're about systemic stability. And for that reason, appropriate capital rules for federally regulated insurance companies may depart in important ways from state risk-based capital rules. The legislation, the bill that as I read it, affords the Fed that discretion. What I am concerned about, though, is the last provision in the bill that would prohibit, as I understand the language, the Fed from demanding information from regulated insurance companies that is not included in SAP reports. One thing that we have to take away from the financial crisis is that systemic risk arises in unpredictable ways, and a regulator must have the capacity to adapt to new circumstances to gather information in a way that allows it to see the full panoply of risks. There are ways in which SAP may not allow the Fed to do that. The most important and most clearly recognized is that SAP is an entity-centric accounting approach. It is not designed to reflect the risks of an entire conglomerate. It is designed to reflect the risks of individual insurance entities. It is very difficult, if not impossible, to get a sense of an entire insurance holding company simply using SAP. For that reason, it very well may be appropriate for the Fed to require either GAAP reporting or something different than either SAP or GAAP, maybe something that is referred to as GAAP Lite. Whatever it is, the Fed has to have the discretion, if it is going to regulate insurers appropriately, to demand the information it needs to adjust to the demands of systemic risk regulation. I am concerned that the provision in this bill that seeks simply to prevent duplicative accounting will actually be interpreted to limit the Fed's authority to demand relevant and necessary information from the entities that it regulates that is not captured in SAP accounting standards. I am also concerned about the Data Protection Act. The Data Protection Act may indeed retain the FIOS and OFR subpoena powers, but it has a provision that is virtually unprecedented as far as I am aware. That provision requires either the Treasury or the OFR to reimburse companies to the extent that they have to comply with the subpoena. The reason that we have the FIO and OFR monitoring insurance companies is because they raise certain systemic risks. Because they raise those risks, we need to make sure that those risks don't come to fruition. The costs associated with that should be borne by the company. If we force FIO and OFR to bear those costs, then we will politicize the subpoena process, and we will make it very difficult for that process to move forward in a way that is predictable. Thank you very much.
Thank the gentleman. And we'll now start questioning. Each member will have 5 minutes, and the Chair recognizes himself for 5 minutes. Mr. Hughes, in your written testimony, you mentioned that this bank-centric standards would harm the ability of life insurers to perform their fundamental business. You know, we've thrown around a lot of terms here, bank-centric, capital standards and stuff, but, you know, I think one of the things that sometimes we have to do is we have to boil this down to the people that we're really trying to help here and to protect, and that is your policyholders and my constituents. Talk to me about, you know, if the Fed were to move forward, if we didn't correct this, the young family out there in America, how could this impact them? Because I think that's the real issue here.
Well, Mr. Chairman, maybe one easy example to address that question. To address the needs of that family, life insurance companies often issue protection products that have promises that extend 20, 30 years out. We back up those promises of those long-term liabilities with long-term assets, typically fixed income securities, generally high-quality corporate bonds. So in our world of insurance and insurance regulation, our regulators like to see that 30-year promise to the family backed up by a 30-year high-quality bond. And the matching of the asset and liability lowers the risk of the enterprise. You take the same portfolio security, that same long-term bond in the portfolio of a bank, which has demand deposit obligations, very short-term obligations, and federal bank regulators say quite correctly, well, that creates a risk mismatch for the bank. They have short-term obligations. You don't want to back that up with an illiquid long-term bond. So the Fed would say the capital weight you give that bond, it has a very high capital requirement because it's highly risky in the hands of a bank. Well, they basically would be forced to do the same thing for an insurance company. And I can't imagine a scenario where the promises we make to that family, that 30-year promise, is backed up by short-term treasuries. I don't know, the risk of not being able to meet that promise 10, 20, 30 years out would be much higher. So that's an example of the same security in the hands of an insurance company as in the hands of a bank, and 4510 would enable the Fed to say, okay, it's a totally different balance sheet. Let's look at assets differently for an insurance company than we would for a bank.
And so that additional liquidity and capital would relate to higher premiums for the product that you've been offering?
Absolutely.
Yeah.
Absolutely.
So that's how in other words, ultimately the policyholders are going to pay for this mismatch in policy if the Fed were to continue. Mr. Carroll, would you agree with that statement?
I agree with that completely. Particularly with property casualty, the liabilities that a bank the liabilities that a bank focuses on are subject to different risks than insurance, particularly property casualty insurance. The bank has credit risk, the bank has inflation risk, the bank has market risk. Where with a property casualty insurance company, it's basically the risk of the damage to the property or the underlying risk. It's a completely different business.
Mr. Coleman, you want to comment on that?
No, I would agree with both Mr. Hughes and Mr. Carroll. I mean, the core issue here is the businesses are fundamentally different. It would increase cost and then potentially create capital that would be addressing asset risk rather than liability risk. So in my view, it would be no more appropriate to apply risk-based capital rules to a banking entity, which would, create potential adverse motives for the wrong risk.
Thank you. Mr. Carter, who would benefit most from the Modernizing the Liability Risk Retention Act as proposed by Mr. Ross? Who are the beneficiaries?
Well, Mr. Chairman, I think that's a great question. And as we think about providing additional services, additional coverages to our members, we think about the smaller to mid-sized businesses. So in our world, it's educational institutions that don't necessarily currently have staff. They haven't staffed for all of the training needs, all of their risk management and risk management needs. And so when we think about actually offering property packages, property coverage offerings in our packages, we're thinking about ways to help them manage those risks in an additional, at a higher level than they do today, in a way also that helps them maintain their budgets, not necessarily have to, we're giving them support, in other words, whether it's white papers, whether it's online training, whether it's on-site visits, any number of webinars and seminars. We're giving them a lot of support through the Risk Retention Group model. And that's not only for United Educators, but also our Risk Retention Group peers. We're only owned by them, and we're delivering more than just insurance to them. So this expansion would be very important to them.
I thank the gentleman, and now the ranking member, Mr. Capiano, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Chairman. And again, I think we've heard many of the items that relatively are non-controversial. And to be perfectly honest, maybe I'm wrong, but I think that the capital standards issue could be put on a suspension calendar and passed overwhelmingly. With a question about the GAP versus SAP, I'm not sure how I feel about it yet, but I have some questions, but I'll come back to it because I don't know what time I'm going to have. I want to talk about the things that are more concerning than some of the other bills. And again, all these bills have things that are easy to support. Some have questions. In particular, in 605, why, Mr. Carroll, I think I'm right that you testified in support of that. Why would we have to get rid of the orderly liquidation as a final backup opportunity? It's not the primary backup opportunity, not the primary process as I understand it. But if everything else fails, why should we get rid of that? And how does it hurt to have one final backstop? God forbid we get into a situation where it's necessary. How does it hurt the industry? And if I'm wrong, I thought you were the one who testified in favor.
No, our position is that the orderly liquidation authority should not apply, that the state-based system is adequate at this point, and they're requiring duplicative payment by insurance companies is not fair, that there's sufficient backup by the state.
So it's the upfront payment that you're concerned with?
Well, if the insurance companies are paying into the state authority, which is adequate, our feeling is that if the other banks and other financial institutions aren't paying into that as a backup to them, we shouldn't have to pay into the orderly liquidation authority.
Again, I really have to go back to Mr. Schwartz's comments. I mean, I have no problem with the concept of state-based regulation. AIG was regulated at the state level. We keep forgetting that. And I understand fully well that the state regulators said that they don't do CDOs, which, of course, is a lack of state regulation. So if that doesn't concern you, if that doesn't kind of ring a red bell, and I'm happy to look at other ways. I am not looking to impose it. I just look at the orderly liquidation when it comes to insurance companies as something, hopefully, God forbid, we'll never need. But I have a hard time saying, after what we just went through, I don't want to go through that again. And that's what the whole orderly liquidation is all about, is to try to prevent us from ever having to do that again. And again, if it doesn't work here for insurance companies, I am more than happy to discuss it. But to just throw it out, I think is raising a risk that's potentially repetitive. And if it's overly burdensome, more than happy to talk about it. I'd like to have some discussions at a later time, maybe not now, but to walk me through how we can maybe rebalance that. Again, I'm not trying to hurt anybody, but
I'd be happy to talk about it.
I'd like to. And I guess I also want to talk about the reimbursement aspect. Again, FIO, limiting up their subpoena power, that's fine by me. I mean, they've never used a subpoena to my knowledge. And I'm not looking, I totally agree that they should ask everybody before they get the subpoena. Why in the world would we want them to, if they have to get to the point where they ever have to use a subpoena, why would we want to force a reimbursement? We don't do it to ourselves. Congress asks every single agency in the world for document upon thousands of documents. Mr. Neugebauer and I were part of an oversight committee a few years ago. We got reams of documents. We didn't ask for reimbursement, because asking for reimbursement is de facto a punishment, and in this case, it would, for all intents and purposes, say, how dare you ask for it? Why do we need the reimbursement aspect if you actually think that at some point FIO would ever need it? Anybody support the reimbursement provision?
My understanding of both the OFR and FIO is that they are not enforcement entities. They are basically entities that exist to determine what's going on in the market, to predict what's happening.
Information gathering, that's correct.
And to get that. And the amount of information that's available to them now through the states and through the companies is extensive. We really don't know.
Which is why they've never used the subpoena power. They've never had to use it. And their likelihood of ever using it is minimal.
And everything we can think of is that if such a request came through, it would be so extraordinary that, one, it should go through the Secretary of Treasury.
I have no problem with that.
And that if it is that far outside of the business of the normal business of the insurers, that it would be fair to have that being reimbursed to the insurers.
But all that basically does is, if it's so far out there, again, I guess it depends. I would actually think if it's so far out there, maybe there's a real problem that they're not getting answers to. That's the last step before a subpoena. And again, I have no problem having the Secretary of Treasury sign off. But it just says to me, basically, we're not giving it to you, period, end of issue. And if you do, you're going to pay us for it. And by the way, it's going to be an extraordinary amount of money, because these things do cost a lot of money. And hopefully, just having the subpoena power there is really what gets cooperation. This committee has done it relative to HUD. We've worked out between ourselves, not issuing a subpoena, having HUD come up with certain documents that we worked out in an agreement after some pressure was put on. It just strikes me as a problem. I guess my last 14 seconds is, with today's world, GAAP and SAP, it really doesn't matter to me. GAAP, SAP, FAP, LAP, it doesn't matter. Pick one accounting standard. I don't care which one. Why would we not want to have one uniform accounting standard so we can compare apples to apples? Now, I understand that a transition from any accounting standard to another one is always problematic. Why would we want to have 2 or 3 or 4 or 10? Why not just one? And it doesn't matter which one to me. Pick one.
I thank the gentleman. And now
we'll get to that later. That's all right.
I'm sure that if you'd like.
No. Yeah. It was a rhetorical question.
Okay. All right. The chair now recognizes the vice chairman of the committee, subcommittee, Mr. Lukemeyer from Missouri.
Thank you, Mr. Chairman. Interesting discussion today. We had discussion earlier today with regards to systemically important institutions and had the whole discussion about capital requirements, Basel implications, international, standards that are being applied to our companies. It's like, holy cow, this is like subcommittee repeat 2.0 here. But it's great to be with you, and thank you for your testimony, and it reinforces a lot of what we heard this morning. Mr. Coleman, I'd like to start with you. Your company, as I understand it, not only is it an insurance company, it also owns a bank. Is that correct?
That's correct.
So you understand firsthand the difference between the two, and that the capital requirements for each one are completely different. They're two completely different business entities with two completely different business models. What do you think about the capital requirements of banks being applied to insurance companies?
Thanks for the question. As we said earlier, I think they're fundamentally, as you said, different businesses, and accordingly, applying capital standards to them in the same way would be inappropriate and perhaps risky. Again, as
risky.
Said,
okay, how do you define risky here? Would these standards affect safety and soundness of the bank and/or the insurance company? How's it going to affect costs to your clients, or the insurance clients, the bank clients? Can you give us a little synopsis?
I think first off, you have the potential by applying an asset-based capital model to insurance companies would not appropriately address the risk of an insurance company, particularly a property casualty company like Westfield, where the majority of the risks are underwriting and reserve risk. So that capital approach could be misguided and put policyholders at risk by not adequately addressing the main risk of an insurance company. The alternative would be true if you had tried to apply, an insurance-centric approach to a bank. We're not talking about that, but trying to think about it the other way helps lend clarity to how inappropriate it would be to apply those rules to an insurance company. And I think there's a potential in doing that to certainly add costs to policyholders and consumers in the event that you come up with an inappropriate capital amount and or more complexity.
Mr. Carroll, your group, they deal with lots of different sizes of insurance companies. Would this, how's it going to affect the small ones in your group versus the large ones in your group?
I think these types of standards would affect the smaller companies much more. They have less ability to adjust to.
Would it drive them out of business?
It could.
What do you think the potential is for the smallest 25% of your companies? How many of them would you think?
We have members who write in a single county. We have members that write in very small areas, and to apply these types of standards, or the potential for applying these types of standards to them, could put them out of business.
They don't have the ability to raise the kind of capital it's going to take to make this all work. Is that what you're saying?
Yes.
Okay. Mr. Hughes, you deal with life insurance folks. What kind of costs do you think would be pushed on to your clients if some of these standards would be implemented? You have a different business model, a little bit different business model than P&C guys.
Yeah, it is. I mean, for us, it's the cost of capital.
Right.
I mean, if we have to have inordinate capital charges because of the long-term securities we're holding to match long-term liabilities, as the chairman noted, it's going to force companies to pass on those costs to policyholders, raise the cost of insurance.
How many of your companies went out of business in 2008 as a direct result of the downturn?
We had two very small companies that went out of business, ironically, because they had an inordinate amount of their reserves in Fannie Mae preferred, both of them.
So it wasn't management of the company; it was the investments that they made. Is that right?
Precisely. Yeah.
Okay. So out of all that turmoil, you lost two small companies, and now you're being impacted in a very negative way with these cumbersome and overzealous regulations. Thank you for your comments. I yield back, Mr. Chairman.
I thank the gentleman, and now the gentlewoman from New York, Ms. McCarthy, is recognized for 5 minutes.
Thank you, Mr. Chairman. Professor, when you were talking, something hit my mind that when we were writing the bill, so I just want to see to clarify it, to see if this satisfies you. When you were making points about SAP and GAP, and I agree with my ranking member, our bill says an insurance company that is not federally traded and is already regulated by the state level is not required to prepare a GAP statement. But that doesn't stop the Fed from asking for additional information, because we were concerned about that. Because I happen to think most insurance companies are good players, but we wanted to make sure that we could keep them to be good players. So I hope, and if you have any questions, we'd be more than happy to sit down with you.
Sure.
And talk about it.
So two just quick points. The first one is that it may be necessary for certain insurers, in order to arrive at a consolidated sense of how risky the company as a whole is, to have GAAP reporting. And that's because SAP reporting is inherently entity-centric. It doesn't allow for the positioning of all assets and liabilities on a single balance sheet in a way that is simple. Okay, and so the Fed, I know right now, is investigating how they can take SAP and leverage it to get at a sort of holistic perspective on a group. But from my understanding, this is very difficult, if not impossible. The second point, though, is I'm concerned with the current language, that if the Fed, for instance, said, look, we don't need you to give us a full GAAP reporting, but what we do need is say line 5 of a GAAP report on this, or whatever it is. We'd like you to provide that to us. The company could come back and, under the language as I read it, say, no, we are not required to provide you anything above and beyond what SAP requires. And so, to the extent the information you are seeking is not encompassed within SAP, you are overstepping your bounds. And the reason I see that is because otherwise it's very hard to understand how you could effectuate this principle, right? Because what if they ask for 5 items on the GAAP report, or 10, or at some point it becomes the full GAAP report. And so I think that there needs to be clarification about the Fed's capacity to get individual pieces of information. And I also think that there may be circumstances in which it would be, in fact, appropriate to have full GAAP reporting if it's necessary if such reporting is necessary to arrive at a holistic sense of the risk that an insurance group poses.
As I said, we'll follow through with that, and certainly, we'll talk to Congressman Miller, because we had the intentions that there would be a stopgap there to be able to have the Feds ask questions if they felt that there was something reasonable there. But thank you, and we believe that we covered it, but we'll take a second look at it. As far as the others, I know everybody in Congress, or I should say the American people, the majority of us actually do work well together. We sit together, we try to work out things that we know are going to affect us back home in our states and certainly our businesses. So I think this is a perfect opportunity that you can see what we do. And we have worked on this committee bipartisanly. It doesn't always work, but this time around it truly has. So with that, from the testimony that I heard, and I appreciate everybody coming in to give their opinions on it, and I think all the questions that I would have asked have already been asked, so I'm not going to ask them again. The testimony has actually been very excellent, and I think it just shows that we can work together. But I will say, during the Dodd-Frank, and I actually like to call it Frank-Dodd, we spent 1.5 years working on that bill together, all of us, and we all had questions. Unfortunately, when it went over to the Senate, they had a very short period of time to work on it and didn't look at the consequences on some of the language that they put in there. I will say that Barney Frank took one section, and even when we went to the second section, we went back to the first section to see if we were countering each other. But as this place has never passed a perfect bill, it will never pass a perfect bill. But that doesn't mean we can't make technical changes, and that's what we're doing today. With that, I yield back the balance of my time, sir.
Thank you. With that, we go to the gentleman from Wisconsin, Mr. Duffy.
Thank you, Mr. Chairman.
5 minutes.
Thank you. Whether Dodd-Frank or Frank Dodd, or sometimes we call it by other names as well. But we won't say that here. I do appreciate the bipartisanship that has gone on in regard to some of the bills that were proposed today. Maybe the panel could help me a little bit with some history. Is it fair to say that we have a pretty long and deep history of banking in America and some crises that come from the banking sector? Does banking sometimes create risk throughout our history for the larger economy? Anybody? You guys all agree with that, right? Am I not crazy? Banking creates risk on occasion. That's why we all kind of come together and go, we get really freaked out in banking crises. And what also freaks us out is when the taxpayer bails out banks. We don't like that. We want banks to have sound capital standards, so those investors in banks will bear the risk and the loss and not the taxpayer. And I think a lot of us feel the same way about the insurance sector. Do we have the same kind of history in the insurance sector with creating systemic risk similar to that of the banking sector? Mr. Carter, do you know? Or Mr. Hughes, anyone you can jump in, chime in?
I don't personally believe so. I think that the business models, as we've heard before, are very different, and the way they run their businesses are very different. And I think if you look at the history of failures, of institutional failures, I think there is a difference. I don't know the exact numbers, though, but that would be my statement on it.
And maybe I'll throw it out a different way. If you look at it from the Great Depression to the Great Recession, oftentimes we've had banks that have caused some of these crises and runs on banks. Is there another historical example that you can give me where a crisis in America has been caused by the insurance sector?
Yes.
Mr. Schwartz, I knew you would jump in here. Yes.
Yeah, well, so first, I mean, right, let's not forget about 2008, right? This is a pretty important, salient example. And again, I think it's really important to remember that AIG Securities Lending Program, monoline financial guarantee insurers, life insurers, all of those involved state insurance regulation and involved crises.
And we'll get to that. But besides AIG, any other example you can give me?
Yes. So there has been a historical precedent of a run on a life insurer, an executive life. There was a run.
But systemic risk
well,
it
depends on how you right. So I would say that it depends how you. The other example, ironically enough, would be the '80s liability crisis. I mean, the Risk Retention Act was initially passed because there was a crisis of lack of availability of liability.
Was that systemic risk, however?
Well, it depends how you define systemic risk. It was significant enough that it was on the front page of magazines, and Congress acted to pass a new regime.
But it wasn't going to take down the whole economy like what the theory was in '08 or in the Great Depression. I mean,
I think that's
far
right.
From that.
It was different.
And I want to, does besides Mr. Schwartz, because I've heard many argue that as you look at the crisis of '08 and you look at AIG's role, many will say it was the financial products division that was regulated by the OTS that caused the risk in AIG, and it wasn't the traditional insurance arm that was regulated by the states that really caused the risk in AIG. Do you guys agree with that assessment outside of Mr. Schwartz? I know what your opinion is on this one, but Mr. Hughes?
I think I would strongly disagree with Mr. Schwartz's analysis. I don't think you can point to AIG and say, you know, that equals the whole insurance industry. It doesn't. I think all financial intermediaries discovered during the crises that their risk modeling probably didn't go far enough out, and that worst case was a whole lot worse than they had anticipated. But if you look at the way the insurance industry came through the crises, both the life segment, the property casualty segment, I think without question we came through that crisis in better shape than any other segment of financial services. So yes, AIG was a problem. Yes, there were companies that were under severe stress, but the entire financial system, not only in the United States but globally, was under severe stress. And I think the industry acquitted itself quite well in the crisis.
And as we look at FSOC, they're there to identify risk to financial stability. And we just recently had Prudential that was designated as a SIFI. What concerns me, though, is how the vote on making Prudential a SIFI. You have the OCC, the FDIC, credit unions, the Fed, Treasury, CFPB, which has its own problems, all voting to designate an insurance company a SIFI, but you have the President's designee that was approved by the Senate voting no, as well as Mr. DeMarco from FHFA. And I think, as I finish off here, the quote is pretty powerful from Mr. Woodall, who said, "The underlying analysis utilizes scenarios that are antithetical to a fundamental and seasoned understanding of the business of insurance, the insurance regulatory environment, and the state insurance company resolution and guarantee fund system." You have bankers and credit unions designating Prudential as a SIFI, and those who know insurance best are voting no, saying these other guys don't understand it. I think that's pretty powerful as we analyze how FSOC is looking at insurance. I yield back the time I do not have, Mr. Chairman.
Thank the gentleman. And now the gentlewoman from Ohio, Ms. Beatty, is recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member. And like my colleague from New York, many of the questions have been asked, but I'd like to pick up where Ranking Member Capuano left off. It seems like, as we've been working through Section 171, that we've come to pretty much a good technical fix to this, but it seems like there were still some discrepancies in which accounting standards, and I think that's where Mr. Capuano was going. And it looked like Mr. Coleman and Mr. Hughes and Mr. Carter were getting ready to jump in there. So let me pose the question to any one of you in this fashion. Would you explain how the application of, let's say, statutory accounting principles versus general accepted accounting principles could result in a different compliance expectation?
You know, I think this is one of the more intriguing questions with this legislation. And you know, I read Mr. Schwartz's testimony, and it caused me to go back and read your legislation and what it actually says. There isn't any question GAAP accounting and statutory accounting have fundamentally different purposes. GAAP is overseen by the SEC. It's intended to ensure, you know, fairness in the marketplace, maybe protection of investors. Statutory accounting, as Mr. Schwartz noted, is really to make sure that the solvency of the company is sufficient to protect the policyholders. Now, whether the Federal Reserve Board at the end of the day, given the latitude that your bill would give them, would just say, fine, we're happy with statutory accounting, I'm not sure that they would. We had begun a discussion with the Fed early on to say, you know, it's not that hard to come up with some mechanical analog to consolidated GAAP financials. It's not audited GAAP, but it's, if you need certain information, it's not that hard to come up with some sort of analog that would give you what you want. Now, those discussions stopped because the Fed said, you know, under 171, we can't get there anyway. Even if you gave us that information, we couldn't rely on it. So your legislation would do two things. One, it would enable us to restart that conversation with the Fed. And two, if we did come up with a workable analog, cost-effective, not audited GAAP for a mutual, it would enable the Fed to rely on that in compliance as they comply with their statutory mandate. So as we read your legislation the way it reads now, we think it adequately addresses the accounting issue.
There's no reluctance whatsoever to provide the information. I think the question is to require insurance companies who use statutory accounting, which is based on, as a more conservative system, based on the interest of the solvency of the company, to have them adopt an entirely different set of reporting standards that are based, again, as they said, for shareholder or investor reasons under the Financial Accounting Standards Board, would impose a burden upon our members for a purpose that may or may not be important to the Fed.
The concern I have is that if the solution is, well, you know what, we need something in between SAP and GAAP accounting. Okay, we need you to use GAAP accounting in this respect or SAP accounting in this respect. We need SAP accounting plus. The language, as I read it, is quite ambiguous with respect to the question of whether or not the Fed could demand it. And I think, just on the technical statutory interpretation as an attorney, one could make a very good argument, if one were so inclined, that the companies are not required to provide anything in addition to SAP, or alternatively, anything in addition to SAP that could be construed as being required by GAAP. And the key point I want to make is the Fed, as the regulator of these entities, needs the flexibility to be able to see these entities on a holistic basis and to prescribe accounting standards that facilitate that.
Mr. Coleman?
I would just add, in agreement with Ranking Member Capuano, if we could get to one standard, wonderful, but we're not going to do away with statutory accounting for insurance purposes. And I think, with all due respect, Professor Schwartz, the Fed, in their examination process and otherwise, I think certainly has the ability to request any and all information that they want, and I think most companies would do their best to accommodate those requests. I think at the heart of the stat versus GAAP is the systematic reporting required to the Fed through their reporting system. So there's really no way to, only provide one set of financial data. So I think the requests that you're talking about that are more from a examination perspective certainly would be accommodated. I think it's a systematic approach to accounting that is troublesome, because it does create significant additional cost and complexity to do that reporting, which certainly adds, cost to policyholders and depositors.
Thank you.
Could I just add one thing? I don't want to overstep my bounds. I just want to respond quickly if possible.
Okay. I didn't know if...
Okay.
Quickly.
To be clear, what I'm talking about is that the Fed might decide we systematically every quarter want you to report to us items that are not required by SAP because we want to take those into account, say, in your capital standards. So every quarter we want you to report to us X, Y, Z that are not covered by SAP because we think they're important in terms of us monitoring you on a persistent basis, in terms of us coming up with capital standards, and that's what I'm talking about, and it seems to me that the statutory language would not permit that.
I thank the gentlewoman, and now the gentleman, Mr. Stivers, is recognized for 5 minutes.
Thank you, Mr. Chairman. I appreciate you recognizing me. I appreciate you holding this hearing on these important bills. Before I start, I typically have an aversion to opening statements, so I don't request to do them, but I do want to make sure everybody in the room understands the unique background of my fellow Buckeye, Mr. Coleman, who not only is a CPA, was a CPA at Ernst & Young, has been a CFO for a bank and a CFO for an insurance company, so he's in a unique position with regard to the capital standards clarification bill that we've talked about recently through the gentlelady from Ohio, as well as Mr. Capuano from Massachusetts and others on the committee. I think almost everyone's talked about that bill. But, Mr. Coleman, from your position, having been a CFO at a bank and understanding how banks work and now being at a property and casualty company, can you tell me, do you think a bank and an insurance company are exactly the same and the same exact capital standards would work for the two different business models?
Thank you, Congressman. No, I absolutely, as I stated before, they are different. But I would add that having been a CFO for both entities, I and Westfield would be supportive of strong capital standards for both types of institutions. So I believe that strong and prudent capital standards for banks are necessary, and as well as strong and prudent and appropriate capital standards for insurance companies. The problem herein lies that one or the other is not appropriate for both. So we need unique capital standards.
And is there anybody on the panel that believes that the McCarran-Ferguson model for regulating insurance is not working? Note that no one shook their head no. The state-based standards for capital work very well, and I know that the gentleman from Wisconsin talked earlier about the fact that state-based regulated entities had no problem through the entire financial crisis. And the capital standards that the states are imposing under the McCarran-Ferguson law, which has been working for 70 years, is still working and working very well. And you talked a little bit through the gentlelady from Ohio's questions about the issues with statutory accounting versus GAAP accounting. Is there anything, Mr. Coleman, that didn't come out in that discussion that would cause additional expense to insurance companies, whether they be mutual insurance companies or non-mutuals?
No, I think what came out of the dialogue was appropriate. I mean, I think there's no question that the requirement to provide GAAP statements in addition to statutory statements would be an additional burden, which would basically create expense and complexity, which ultimately would, cost policyholders more in premiums.
Has your company put a price on what that would cost your policyholders?
We have not specifically, no.
Can you tell me, would it be in the thousands or the millions of dollars for a company the size of Westfield?
It would be more than $1 million.
So for medium to large insurance companies, you're talking about 6, 7, 8-digit costs, tens of millions potentially in some companies.
I can't speak for other companies specifically, but that would be my suspicion, yes.
Thank you. I appreciate that. The other bill I want to talk a little bit about is the Data Protection Act that I have a discussion draft out on. It's a bill that's a change from a bill we did last year, and I know there's been some discussion in the committee by the ranking member of the fact that Congress doesn't reimburse, but Congress is usually subpoenaing other government agencies, so it's government agency to government agency. But in Title 18 of the U.S. Code, Section 2706, there is a similar provision to what we're talking about that deals with law enforcement, and when they subpoena commercial or other folks and they reimburse the cost. And I know that Mr. Schwartz, I'm not sure if you said it was unprecedented, but I wanted to make sure you knew the precedent of Title 18, Section 2706. Are you familiar with that section?
Yes. My understanding is that there is not another precedent for a monitoring agency or an agency that is meant to assess risk to a marketplace having to pay for that. And I'd also say that even in the context of subpoenaing...
And I'm running out of time, but those are regulatory agencies, and that's why. And so the state-based regulators regulate, we already talked about that under McCarran-Ferguson, regulate insurance companies, but this is additional, this is much more akin to the law enforcement model because these are not regulators. So thank you for the time, Mr. Chairman. I know I'm out of time. I appreciate the witnesses' cooperation, and thanks for being here. I appreciate your information.
I thank the gentleman, and now the gentleman from Florida, Mr. Ross, is recognized for 5 minutes.
Thank you, Mr. Chairman. Professor Schwartz hinted earlier about a 1986 crisis in insurance that I think led to what resulted in the liability risk retention amendments that I think have done very well. In fact, Mr. Carter, if it were not for the risk retention groups, what would your members avail themselves to in terms of a market for liability coverage and, in this particular case, in my draft, property insurance coverage?
Well, I think, thank you for the question. I think during the times of a crisis when most of the traditional insurance markets do not feel that they can continue to offer the coverage, it's very, very difficult for the businesses to find the coverages that they're going to need, whether that...
And you have a unique risk, too, don't you? Your members have a unique risk that you don't find in a commercial lines product. Would that not be the case?
Well, I think to the extent that there's liability, that obviously there's liability inside of our industries as well as others. However, you're correct. The industries, the specific industries that turn to risk retention groups and tended to gravitate to them, nonprofits, educational institutions, many of those were difficult to cover for those traditional insurance markets. So we were formed during that time, and what makes the model really work is during very difficult times over the course of the years since that time, and there has been at least one event that has changed the market, or created a market cycle, I should say. Risk retention groups tend to grow quite a bit because of our commitment to those members. So we're not looking to grow outside, or we can't grow outside of that.
Correct. You can't offer your product to somebody else
We cannot
outside
offer
your membership.
That is
I mean,
correct.
you're not in the business of being an insurance company. You're in the business of providing a particular service, in most cases a nonprofit or charitable service, for which you have a unique risk. Now, if you didn't have the risk retention groups, is there a residual market for coverage?
Well, not that I know of.
And if there was such a market, wouldn't it have to be most likely provided by a government?
I do. That is correct.
Such as an assigned risk pool.
That is correct.
Such as what we saw in Florida and what we've seen in other states. So if we don't have affordable coverage for your members, then they can't provide their service. And if they can't provide their service, which is a nonprofit charitable service, then one, where does the client go? And two, who insures that risk? Because just because the services aren't being provided by your organizations doesn't mean the risk for those services is not going to still be out there, because somebody, most likely a government, will provide those services.
That is correct.
Now, with regard to capital standards, and I just want to ask Professor Schwartz this particular question. I understand I just want to make sure you're not suggesting that FIO now have regulatory authority, are you?
No.
Okay. And when you consider the cost of compliance as well as the cost of increased capital having to be held, would that not play into a cost-benefit analysis as to whether a regulation should be implemented or not?
Yes.
And in this particular case, if we're not clear on the Collins Amendment and that we don't have bank-centric capital standards apply to insurance companies, we may very well have a situation where the cost of compliance may outweigh the affordability of the product.
Yeah, I'm in agreement that the language making clear that the Fed has discretion to tailor capital rules to insurers is a good idea, and I agree that the cost-benefit analysis is relatively clear on that.
And I would assume as well, Mr. Coleman and Mr. Hughes, I mean Mr. Carroll, I'm sorry, yeah, with NAMIC.
Yes.
Yeah. I yield back.
I thank the gentleman, and now the gentleman from New Jersey, Mr. Garrett, is recognized for 5 minutes.
Great. So thank the panel again. A whole bunch of areas. So going back, I start on the right. Mr. Schwartz, or Professor, so you made the comment, if I want to see where you're going on this, you made the comment before that there were a number of insurance companies who had problems and failed regulations, and you referenced AIG and a couple other ones, and for that reason we should have, in your word, turn some of this over to federal regulation in this area. I'm paraphrasing.
Yeah, I mean, the basic argument, right, is that we saw that insurance can be systemically risky in more limited circumstances than banks.
Right.
For that reason, we need a federal layer of oversight and protection.
Right. And I think, Mr. Hughes, someone asked you about how many carriers, insurance companies failed, and I think you alluded to that only a handful, and a couple of them actually failed not because of their own doing, but because of federal regulation, because they were encouraged to buy trust secured in Fannie and Freddie. So so this is where I'm sort of confused, Professor. If you look at the numbers, the number of insurance companies that failed is on 1.5 hands. It's AIG and a couple other ones. And actually, weren't the two major companies that failed actually also regulated by the federal government at the same time?
So to be clear, there were several insurance companies that received TARP bailout funds, many more that applied. Okay, so there were many, and there were many insurers that contributed to the crisis without necessarily failing.
Okay,
one important point to recognize.
Well, the important point is that by and large they didn't fail, or they didn't actually have to get government backstop or support, except for a couple.
Well,
and the ones that did get the support actually were regulated. The AIG, who bailed out the most, probably of all of them, the Office of Thrift Supervision, they were supposed to be doing it. The other one at the very top that got it was a bank holding company, and who would that? Wasn't Hartford a bank?
Hartford was
not a bank holding company.
I do not believe it was.
So AIG would have been the top. They were government supervised. So it seems as though the ones that got the most money also had a federal regulator that failed. And if you look at the most businesses or financial institutions that failed, they would be on the other side of the ledger. They would not be insurance companies. They would be the banks. And weren't the banks regulated by the Fed?
Well, you know, it's funny. We all keep talking about the banks. A lot of the crisis was caused by an unprecedented expansion of shadow banking. So the point is this.
So I know the
keep
point,
saying,
right?
but that was new. And the point is you can't just say, oh, well, banks are the problem, so banks are going to be the problem in the future. Systemic risk arises in new ways.
Right, and that's why we need to have regulators who do the job. But apparently,
right,
the
monitors and regulators who have the powers to do the job.
Right, but the regulators didn't do their job. You know, we had Secretary Geithner here back in '09, and he was answering a question. I was just seeing this from earlier, and he said that in '09, after he had just left the New York Fed, that, in his words, I just want to correct one thing. I have never been a regulator, for better or worse. So here's a guy, one of the regulators that we're supposed to be turning all this control over to, being paid $400,000 a year, being in the job of heading the New York Fed, testifying to Congress, I'm not a regulator. Is this exactly where we should be in turning over the authority to when, as Mr. Hughes and others on the panel have testified to, we don't really see the problem on the state level. We see the failed regulation at the Fed, at the New York Fed, at the Office of Thrift Supervision, on other issues outside of the realm of this panel, such as the SEC, with other areas as well. It seems as though it's endemic. The problem is where the federal regulators have gotten involved and failed to do their job with the authority that they had at the time. And matter of fact, we all go all the way back. We asked the regulators when they came in right after the crisis of '08, did you need additional authority or power at the time? And they said, no, we just didn't see what was happening here. And what we're trying to go forward, your suggestion is that we just need to give the regulators even more authority and more information. But would you agree that there is some limit that we should impose on the information that they should be able to acquire?
Of course. I think that the information should be, whether or not they request information, should be based on a prudent judgment of the need. But I would also just want to correct the point
correct me if I'm wrong, Dodd-Frank gives the FIO subpoena authority, correct?
It only allows them to use that subpoena authority if they've made a determination that they cannot receive the information from any other source,
right, but isn't that
state
unusual?
or federal.
Can we cite any other case where you have subpoena authority where it's not in criminal or an administrative
One of the things that Dodd-Frank did to address the fact that systemic risk is always changing is create institutions like OFR and like FIO that are meant to try to anticipate these. Are they going to work all the time? Of course not. But the answer
is there any other
that
institution that has that authority right now when it's not a criminal or administrative position?
Well, I think that they're a unique organization, but I think on the scale of regulation versus crime enforcement, they're a whole lot closer to regulation than crime enforcement. And they're doing a job that is monitoring systemic risk, which is, in a sense, much closer.
I yield back. Thank you.
I thank the gentleman, and now the gentleman from California, Mr. Sherman, is recognized for 5 minutes.
Okay. Thank the chairman. I notice in talking about risk retention draft, there's a noted absence of necessary speed with which to take this up. I assume because there may not be a push from the groups really pushing that effort forward. Wonder who would want to comment about the speed of the dealing with the risk retention draft.
That would be my area, but I'm not quite sure I understand the question. Would you mind repeating it? I didn't hear the first part.
You know what? I think I'm going to go on. Who can comment on why we wouldn't regulate credit default swaps as an insurance product? Mr. Hughes?
Personal opinion, it's a form of financial guarantee insurance. I think it probably should have been in a monoline company and not part of a multi-line company.
You're saying it should be part of a monoline company, but a regulated insurance company?
That would be my personal opinion, yes.
If I had decided that I wanted to be in the fire protection business, but my deal was this: if your house burns down, I don't write you a check. That would make me an insurance company. Instead, if your house burns down, you can trade your house for a U.S. government bond. Would I be a fire insurance company, or could I evade all fire insurance company regulation?
You would be an insurance company.
What?
You would be an insurance company.
I'd be an insurance company if I did a burned home for bond swap. But if instead of it, your home burns down, you can trade it for a U.S. government bond, that would make me an insurance company. But if your portfolio burns down, you can trade it for a U.S. government bond. I'm not an insurance company, or at least I'm not defined as one under U.S. law?
That's exactly,
Professor?
yeah, that's exactly, the boundaries and the fact that we have regulatory arbitrage and we have insurance companies engaging in many of the types of activities that banks and shadow banks engage in is exactly why we can't ignore the systemic risk of insurance companies. We can't simply say, oh, well, the states are doing a fine job, so we're going to leave them alone.
Well, wait a minute. That credit default swap that I just described is not, cannot be done by a regulated insurance company, correct?
Correct, but monoline insurers, financial guarantee insurers, did the exact same thing, and they failed miserably as well. State-regulated insurance companies issuing financial guarantee insurers, they failed just as dramatically.
They failed to the point where they had to be bailed out?
Well, they didn't have, they failed to the point of insolvency, to the point of contributing mightily to the crisis, yes, because what happened is all of a sudden the financial guarantee insurers were providing, their classic business was to provide insurance against the default of local bonds and state bonds. When they failed and became insolvent to the point that no one had any faith in them, the entire bond market seized up because there was not financial guarantee.
Well, we in Congress didn't have to bail them out.
I don't believe that any of them received bailout funds.
Okay. Has anybody put forth an argument against the Policy Holder Protection Act simply making it clear that you can't raid the insurance company to support the depository institution? We've got a whole panel of here. Somebody raise your hands if you've got an argument against the bill. Wow. We passed it unanimously. Thank you. Okay. I'm going to amaze my colleagues and yield back 46 seconds.
I thank the gentleman, and now the gentleman from Florida, Mr. Posey, who has a couple of bills that we've been considering today. You're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for hearing today's legislation. It's very important to the insurance industry and for allowing me the opportunity to speak today. A question for Mr. Coleman. Dodd-Frank requires insurance companies to can be made to serve as a source of strength for affiliated depository institutions. State insurance regulators wall off assets of insurers from other affiliated companies because insurance assets are supposed to be available to ensure an insurer can meet its obligations to policyholders. But if an insurer is expected to serve as a source of strength to non-insurance firms, couldn't that harm the insurer's policyholders? Why would we favor protecting consumers of banks and other risky financial firms over protecting innocent insurance policyholders? I mean, they're the most innocent potential possible victims. It seems like we want to focus, Mr. Schwartz wants to focus on protecting the investors in these institutions that, can't keep themselves in business, rather than worry about the victims when they're forced to go out of business. Just like your thoughts.
I think to answer your question, we shouldn't jeopardize the policyholders of an insurance company that's state regulated in order to use those assets to divert those to support banks in a bailout.
And I realize health insurance is different. I mean, every insurance is unique, but they all have something in common, and that's people buy insurance to reduce risk. They don't buy insurance to increase risk. And if you start stealing from Peter to pay Paul, what you may have, instead of one guy going out of business, you get two. And I don't know how that's better for anybody, but my experience with federal regulators in the insurance business, I don't know, Mr. Schwartz, if you've ever heard of TRG, but it's a health insurance company that wrote insurance policies in 48 states, darn near every state but their own, which was in Indiana. everything was fine except they didn't pay any claims. And they bluffed most of the state insurance commissioners into thinking they couldn't go after them because they were under the federal ERISA program.
To be clear, I also support.
And finally, one state said, you know, if the federal government's not going to do anything, maybe we will. And 13 state agencies from different states cooperated to bust those dirt bags and put the principals in prison. To this day, the federal regulators have done absolutely nothing. They have brought no charges. They're just, you know, paralyzed with inactivity. So when I hear somebody kind of insinuating that state regulators are bad and federal regulators are good, you know, my experience has been just the opposite. And while we all believe, I think probably most of the people here have come up through various levels of government, they know that the government closest to the people is usually the best, the most responsive, the most efficient, the most effective, the most cost-effective, and certainly the most accessible. And I think that goes for regulators too. I think that goes for law enforcement too. I think, you know, all services that are regulated more closely. Now, I see nothing wrong with cooperation from the federal government to, unlike what they did in the TRG case, to facilitate enforcement across state lines, but I think the state regulators are, you know, fortunately for most consumers, the best line of defense against innocent victims. Mr. Chairman, I want to thank you again for bringing these up. They're very important issues.
And
I'll go back.
There are no other members seeking recognition. I'd like to thank each of our witnesses again for their testimony today. Without objection, I'd like to submit the following testimony for record: a statement on behalf of the Independent Insurance Agents and Brokers of America, a statement on behalf of the American Insurance Association, a statement on behalf of the Financial Services Roundtable, a letter from the National Association of Insurance Commissioners, and a letter from over 50 CEOs regarding the Miller-McCarthy bill. Without objection, all members will have 5 legislative days within to submit additional written questions to the chair, which will be forwarded to the witnesses. Ask our witnesses to please respond promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And without objection, this hearing is adjourned.